we get into my favorite topic in this class, which is risk management. We could spend a lot of time on risk management. It is by far the single most important topic in finance, probably the single most important topic in business, whether you're marketing, accounting, finance. Cybersecurity obviously is 100% risk management. This is the most important thing we do is manage risk. You did that in your cost benefit analysis with your team, where you're covering risk by your discount rate, but you're also looking at the worst case scenario and the best case scenarios. So risk is extremely important to decision making. Before we get in here into this section, in Amazon, there's several books I highly recommend on this. One is a book by Peter Bernstein, Bernstein. He's written several books that I recommend, but this one called Against the Gods, it's a really good book. It's the history of risk. And one thing I like about Peter Bernstein and his writing, when he writes about finance, he tends to do it chronologically or historically, so that you get the foundation. So he says this: we learned this, and because we learned this, we can now do this, and he takes you to the next step. So you understand things as building blocks, which I sometimes think is the way we should teach finance. We do finance a little too shotgun like, where we just throw a lot of things at you at once, versus Bernstein. If you get through his book, it really is foundational. Each chapter is foundational to the next, and you see why what happened in the 1700s had to happen before the 1800s, what happened in the 1950s had to happen before what we learned in the 1960s. So it's a great book. I actually have this book with his autograph. Peter Bernstein unfortunately passed away a few years ago, but a really good writer. Another great book in this area is Doug Hubbard. I strongly recommend a lot of his book. Your cybersecurity majors, I've recommended this book. He has a new book out on cybersecurity. But the two books I really recommend by Hubbard, one is How to Measure Anything. Excellent book. Very easy, very good read. It's not an overly technical book. And then his book here, The Failure of Risk Management, Why It's Broken, How to Fix It. This is an Audible book, but you also get it in paperback. Also, Doug Hubbard, a lot of his teachings are out there for free on YouTube, so you can actually go to YouTube and type in his name and watch some of his conference presentations. They're very good, very great, insightful teacher. And then who's become one of my favorite writers and speakers now is Annie Duke. She wrote this book, Thinking in Bets. And if you think about life as a poker game, poker is very much a risk management type of game. Very different than chess. Chess is don't make mistakes. But with poker, you can do everything exactly right and still lose. If you do everything exactly right in chess, you'll win. But in poker, you can make all the right moves and still lose. So you have to think about risk, because risk involves first your skills and your decision, but risk also involves some aspect of just chance, pure chance. And she talks a lot about that. What I really like about Annie Duke's book is the practical side of it, is how to really deal with risk. So Annie Duke, definitely. Kahneman is the one people think about the most. Both of these books right here, Thinking Fast and Slow, is a really good book by Kahneman. Very famous book. Really, every business major should read this book. It's an extremely important book. And then this Michael Lewis book, you've probably heard of Michael Lewis. He's written a lot of famous books about finance. The Undoing Project is a book about Kahneman and the man he worked with, Tversky, and what they found and how their analysis has very much undone a lot of finance. Andrew Lowe is another one. Boy, there's so many books. I have a reading list. If you want my reading list, certainly email me and I'll send it to you. It has all these books in it. Adaptive Markets Hypothesis, The Financial Evolution at the Speed of Thought, really good book. These are just a few of them. There are so many great books out there on risk management. All of them should be read. They're all very important books. And so when we get into risk management, just realize we're only going to scratch the surface. We're not going to get into this. The risk management class I teach, we get a lot more into it, but even in that class, there's just a limit to what we can do. There's so many fields of study. I could give you so many theories. You might like some of them, you might hate some of them, but you really want to be exposed to as many of these theories as you possibly can. So I have a list of risks. Some of these are pretty laughable because compared to what happened in 2008, even what's just happening here in 2020, some of these seem like really small risks now, but at the time they happened, they were huge. So why did these things happen? So Barings Bank, there's a great book out there. You can look this up. There's a book called Rogue Trader by Nick Leeson. Nick Leeson was the rogue trader. He brought Barings Bank down. If you're an accounting major, I would read this book. This is a book where the oldest bank in the UK, the Barings Bank, the bank of the Queen's Bank, went insolvent, all because an auditor did not do their job. And if you read Rogue Trader, you'll see why that auditor should have been doing their job a whole lot better. So this is a great book, a great risk story for accountants and auditors. Orange County, a guy named Nick Leeson, he brought the wealthiest county in the United States. Very, very wealthy people living in this county. He brought this county to bankruptcy because of some really bad decisions he made. This is not one of my favorite books. I do like the story of Orange County and what it teaches us. Jorian is not one of my favorite writers. It's an okay book, but it's not a great, great book like Peter Bernstein and some of the others. ValueJet took on some business that wasn't part of their core business, and it caused a crash with one of its planes, and they just couldn't survive that. Long-term capital management, there's a great book, another book there, When Genius Failed. That's another book I recommend by Lowenstein. Long-term capital management went insolvent in 1998. Just a story of hubris, but also just not understanding the human side of risk management. Excellent, excellent book. Enron went under during my lifetime as a finance person. There are some good books on Enron out there. There's just so many of them. They're pretty lengthy. It's again another accounting and auditing look. Obviously, the auditors went insolvent. Auditors like Arthur Andersen went insolvent because of Enron. Major audit firms have lost a lot of money because they weren't looking carefully enough at the books of Enron. So another good story. I don't know which book I would recommend the most. There's several of them out there. I think they're all a little too lengthy for my taste. Texaco is a firm that, boy, just had some jerks as CEOs and CFOs, racist, sexist CFOs and CEOs, and in their meetings, they had the person taking minutes at their meeting decided to do a tape of their meetings, create a tape of their meetings, and those tapes got out into the public, and it just caused a lot of lawsuits because obviously you hear those kind of things, people are going to start suing for discrimination. Just horrible, horrible management. We're going to talk about this in my risk management class and some close calls I think USAA had in hiring people and almost making CEOs out of people who could have been really disastrous. And I think they just squeaked by and they fortunately got better CEOs. Tylenol is considered the textbook case for public relations and doing good public relations. Tylenol, their tablets were laced, were killing people, and a lot of press, but Tylenol handled it so well that it actually ended up increasing the value of their brand versus harming the firm. Microsoft got sued for antitrust. Europe really hated Microsoft because they were essentially a monopoly, getting too big, becoming essentially a monopoly that can push a lot of power. When you do that, regulators step in, politicians step in. Tobacco industry, obviously all their lawsuits for the health dangers of tobacco. September 11th, people had talked about the risk of airplanes and the cabin doors not being locked and what that meant. But and there have been some close calls before. My property and casualty insurance class, we talked quite a bit about 9/11 because Berkshire Hathaway, the firm that Warren Buffett runs, His firm lost several $billions because of 9/11. And in his 2001 annual report, he talks extensively about the lessons learned because of 9/11. Very interesting study, obviously very tragic because of the loss of life, but also taught us a lot about just very basic risk management. And then Global Crossing, a firm that just planned, that grew too fast. What Global Crossing did was exactly right, but 10 years too fast, too early, got overextended and went out of business. And then you get to 2008, Bear Stearns, Lehman Brothers, AIG, Merrill Lynch, Washington Mutual. Just assuming major tail events, major extreme events just never happened, like housing prices falling throughout the entire nation. That was thought as considered to be unheard of, and then it happened in 2008, and they had all these subprime mortgages. So there's a great article by one of my favorite article writers, a guy named Glenn Holton. I didn't put his name here. I should have. I think it's Glyn Holton. He wrote a book called Enterprise Risk Management, where he asked, why did these things happen? These huge losses happen. He was talking mainly in the 90s. And what losses we're seeing today dwarf those. You know, you look at these losses, 1.7 billion, 1.5 billion, 1.1 billion. When Merrill Lynch was going under, they were losing 15 billion in a day. So, you know, these losses seem a lot smaller. But what have we learned? Well, one thing is just a few people, one individual, a few individuals. A lot of these examples up here, like Barings Bank, was just one person. Orange County was just one person. Long-term capital management, 3 or 4 people are making all the decisions. Dawei Bank, Sumitomo Bank. Dawei Bank was 3 or 4 people. Sumitomo Bank was just one person making decisions. So we've put a lot more power into the hands of few individuals. It could have been prevented with good oversight. That's where Barings Bank comes in. If the auditors had been doing their job, he would have been stopped very quickly. But because no one was paying attention, that one person did tremendous damage. One person can do large losses because of the leveraging impact of these new derivative instruments we have. In my risk management class, I talked about this at USAA. I started doing derivatives at USAA. I loved interest rate swaps. I loved doing stock options. But USAA, they gotten comfortable with me. They know me. They trusted me. And so they let me do all these transactions with no restrictions whatsoever. I could have done these trades. I could have brought the entire company down with these trades. That really bothered me. So I actually set up a process to force USAA to control my activities so that if I made a bad trade, they would stop me. I had to actually control my own activities. One person should not be able to bring a company like USAA down, but USAA actually gave me the authority and the power to do transactions where I could have destroyed that entire company if I had just been in a bad mood. If someone had said something to me, I worked closely with the CEO, and boy, I had some bad days with that CEO. If I just had a bad day and I said enough with it, I'm just going to bring the whole thing down. I don't think I would have ever done that, but you never know when someone's under major stress. You've got to make sure one person cannot do that kind of damage. But up here, you can see they let one person or a few people. AIG is a good example of just a small number of people brought the entire entity down. These other entities, their biggest risks, their biggest losses were small departments that made decisions that were really, really horrible. Washington Mutual was more a decision, just corporate-wide decision to grow their mortgage business as fast as possible, and that just destroyed them. So it's not that bad employees are worse today than they were in the past. It's just we've given them much more powerful tools. They can do much more damage. So risk management is the critical separating between winners and losers. You're going to see things like in 2008 and this year with COVID-19. You're going to see that the whole focus becomes survival. And those firms that practice good risk management will survive. And we're going to see some firms go insolvent in this environment. Obviously, airlines and cruise lines, they're going to get some government bailouts. Maybe we as taxpayers keep some of these firms afloat, but there's still going to be some firms that are just going to go out of business. People are talking about firms like Sears and JCPenney, that this is just going to be too much. They just won't be able to survive this. We'll see. It'd be interesting to see. A lot of restaurants, especially small restaurants, this might be too much. We started a restaurant in Costa Rica, and so far we're surviving. They're doing enough business every once in a while. We've essentially have shut it down and just open up whenever we have a special catering opportunity. But yeah, it's tough for these small businesses to survive. How do you practice risk management in a case like COVID-19? Small businesses, that might just be, you just hope something like that doesn't happen because you just can't survive. So elements of risk management, again, this comes from Glenn Holton's article. You need a good risk culture, and so I strongly recommend, if you're going into an interview, just listen up closely to this. Boy, I tell you, this is really important. At one point, they may ask you to ask a question about the firm. And you don't want to ask, how much are you going to pay me? You know, there's some questions I can definitely give you that you can ask when they ask you. I always ask value type of questions. If I were interviewing for a job today and they say, what do you want to know? I would say, hey, I want to be a value adding employee. I want to know, is this the type of firm that if I learn, once I learn my job, learn this company, and I have good ideas, this is the place where my ideas can get heard and I can have a great impact on this firm. That's what they want to hear. They want employees who want to make the firm better. But here's another series of questions you can ask about, and that's risk management. I want to work for a firm that's serious about risk management, that it's worried about the downside risk, is making sure the firm is covered for this downside risk. Does this firm have a good risk culture? That's a great question to ask. Good companies want you to ask that question. Horrible companies that you don't want to work for don't want you to ask those questions. So if they're upset because you asked the question, it's probably a firm you don't want to work for. Especially if you're a cybersecurity employee, you want to know, hey, I'm here to manage risk of this company, risk of our customers, risk of our vendors. If I see something we need to do, how does that work in this company? How do those ideas get up there? So you need a risk culture. You need behavior. You need to make sure that behavior that reduces organization risk does not create significant personal risk. You don't want to be in a job where you want to say, hey, we shouldn't be doing this. This is very risky. And your boss says, shut up, don't rock the boat, keep quiet. And if you rock the boat, if you bring up the issues, you get fired. You don't want that type of environment whatsoever. So you need to be able to rock the boat. You need to be able to ask questions. You need to be able to challenge the establishment. When I was in the asset group at USAA running billions of dollars of assets, we let interns come into our asset planning meetings, our strategy meetings, and they could speak up. They could ask questions. A lot of times they weren't great questions because they didn't have the background we had, but we didn't care. We had outside parties, someone with new ideas. We had no trouble with them challenging us. We didn't get offended. We listened to them. So you need firms that are willing to listen even to the newest employees. That's the firm you want to work for. What risk culture says what behavior is condoned. When I was at USAA, we had a CEO that, boy, he could blow his top. But the one thing he hated more than anything else was people keeping information from him, especially about risk. I actually got calls from some of the officers, high-ranking officers at USA, asking why I hadn't been fired yet because they saw me beat up so many times in meetings. But what they didn't realize was the CEO wasn't screaming at me. He was mad about a risk that I raised, a concern that I raised. He was actually quite pleased that I raised the issue. And he wasn't yelling at me. He was upset because this issue was there. When people got fired, were people that knew about something that was going wrong and did not let him know. Those are people who lost his job. Because I always brought that stuff to him, even though he beat me up in meetings because of it. I brought it to him. He never even, I don't think I was ever at risk of being fired in that environment. That's exactly what he wanted. It was actually a fairly good risk culture, except people feared his temper. And so I think from that standpoint, people might have kept risk from him, but he wanted to hear it, and he definitely was seeking out that type of information. So good firms, good risk cultures. There's individuals that are responsible for that, for everything, not committees. There's a lot of questioning. There's a lot of people admitting they don't know everything, and so people are, willing to question the established. You need great procedures. I won't get too much in procedures. I'm not a big fan of procedures because sometimes they're just overwhelming. But as I mentioned with my job, they were letting me do trades without any procedures whatever, so I had to create my own procedures. I actually went to the CFO and said, Joe, you're allowing me to do things that are really dangerous. I could bring this whole entity down, but I'm just letting you know I put these processes in place, so I can no longer bring this entity down. I wanted him to know that they allowed me to have this kind of power, and then I wanted him at least to have some comfort that I wasn't this loose cannon about to destroy the whole company. And then technology is real important for collecting information. Make sure the right information is being reported, that people have power to act on it, that you have good risk managers that can actually come in and say, you cannot do that because it violates our policy. All right, so I'm going to stop it there. Next session, we'll talk about the process of risk management, and then we'll talk specifically what we're going to get into. We're going to be doing a risk measurement called value at risk. And so we'll get into value at risk fairly quickly. Our main process is going to define the risk, measure the risk. That's where we're going to use value at risk, and then mitigate the risk. For mitigation, we're going to use something called risk limits. So we'll get into that. That's your next Excel application, which is one of the easiest ones. So we'll start right here in our next session.